Imagine waking up to headlines promising untold wealth. You check the market and see silver has surged to $82 an ounce. Your heart races. You think this is the start of a historic run. You buy in immediately, fearing that if you don't, you'll miss out. But within hours, the price collapses to $78.50. You're down 5% in a single afternoon. This is not a glitch or bad luck. This is a market engineered to separate the weak hands from the strong. What you just experienced is called selling the news, and today we're going to break down exactly how it works, why it happened, and why silver's long-term story is far from over. Yesterday, a major financial institution issued a bullish report on silver, sending the market into a frenzy. Social media exploded, news outlets hyped it, and retail traders flooded the market, pushing silver to $82.75. It looked like the beginning of a historic breakout, but then, almost instantly, the euphoria reversed. Sellers emerged from nowhere, pushing the price down to $78.54, a drop of more than 3% in a matter of hours. If you bought near the high, you were already in the red. This isn't random. This is classic market mechanics at work. Hedge funds, institutions, and big banks often use headlines to create liquidity. They need buyers to take the other side of their massive positions, and what better way to do that than trigger a retail buying frenzy? Think about it this way. A hedge fund bought millions of ounces of silver at $60. Now at $80. It's $80. They want out, but if they sell all at once, they crash the market and destroy their own profits. They need retail buyers to step in, enter the headlines, enter the frenzy, enter the trap. Markets love narratives, and the narrative yesterday was simple. Silver is about to skyrocket to $39 per ounce. Retail investors read that number, panic bought, and created a wall of liquidity at the peak. The institutions then sold into that strength, capturing profits while the retail herd unknowingly provided the exit. This is the oldest trick in the trading book. Buy the rumor, sell the news. The rumor excites the crowd. The news is the cue for the professionals to distribute their positions. The result is a sharp spike, followed by a swift collapse. Look at silver over the past 2 weeks. On December 29th, it spiked to $83.71 before collapsing. Yesterday's rally to $82.75 was rejected again. A double top signals that sellers are defending a price level aggressively. Every time silver approaches $83, the market says, not today. Until the resistance is broken decisively, we're stuck in a range. On the upside, $83 is the ceiling. On the downside, we need to identify support zones. The immediate support lies around $78, which coincidentally aligns with yesterday's low. The major support is $75, the old resistance that has now turned into a safety net. If silver falls below $75, we could see a deeper correction. But if it holds, we are still in bullish territory. Silver never moves alone. Gold is the anchor. This disparity tells us something important. The selling is volatility driven, not fundamental. Silver is the high beta metal. It reacts faster and harsher than gold. While silver swings wildly, gold holds the floor. This is critical. Silver cannot collapse while gold remains strong. Physics in the markets prevents it. The gold to silver ratio has widened slightly from 56 to 57, making silver cheaper relative to gold. That ratio attracts value buyers, including algorithms that arbitrage between the two metals. When a bank issues a long-term price target, the market often misinterprets it. Analysts talk about structural supply deficits, industrial demand, and macroeconomic factors over years. But retail investors read the number as today's price. Bank of America's $300 forecast is for the next cycle, not this week. The fundamentals haven't changed. Silver is still scarce, industrial and solar demand is rising, and monetary conditions remain supportive. Today's $2-3 drop is noise, not a signal that the thesis is wrong. This disconnect between time frames causes losses for short-term traders. Day traders buy a long-term forecast with short-term capital. When the price moves against them, panic ensues. Long-term investors, however, remain unshaken. Banks like Bank of America historically shorted silver and fought to suppress its price. Now, issuing bullish forecasts marks a strategic pivot. Institutions are effectively signaling that they have covered shorts and are now positioned for higher prices. This matters more than intraday price swings. Pension funds and institutional allocators don't trade on YouTube videos. They trade on research notes from reputable banks. A green light from a major bank removes reputational risk and opens the floodgates for massive capital inflows. Think of it like this. While retail traders panic sold at $82, institutions were quietly buying the dip at $78. They are accumulating millions of ounces at discounted prices, preparing for the next leg up. Market psychology drives these spikes and collapses. People bought in haste, ignoring technical levels, risk management, and the broader context. Meanwhile, professionals exploited that psychology. They fed on greed, using emotional traders to absorb their selling. Once the peak was hit, the market collapsed not because fundamentals changed, but because retail sentiment reversed. This is a lesson every trader must learn. Emotion is the enemy of execution. Headlines trigger emotion. Discipline preserves capital. Despite the ugly red candle, several signs suggest this is a temporary correction, not a reversal. Volume during the sell-off was high, but matched the buying volume from earlier, indicating profit-taking rather than panic liquidation. Every dip to $78.40 saw the price bounce. This shows passive accumulation by stronger hands, institutions, pension funds, and serious stackers. They didn't chase the $82 spike. They waited for the market to flush weaker hands, then quietly accumulated. Double tops in supercycle markets often fail to trigger full-blown corrections. Instead, they form a handle, a consolidation phase where supply is digested. Once sellers are exhausted, prices surge past the previous highs. This could very well be the pattern forming in silver.